Right, so guys, let me quickly mark these answers. First of all, guys, potential gain or loss. So in this question, if I can remember, we have a subsidiary called Holloway. Now, I think guys over here we are P, right? We are Plundle, right? We own a business called Holloway. Now we are planning to sell them. Not we have sold, we are planning to sell. So if we do plan to sell, what is the potential gain or loss? Okay, so we did calculate that one, guys. I'll just take the answer from the marking scheme. So it says, right, the potential, right, potential gain or loss. They are telling guys the answer is 15 million, it seems. We got the answer. Right. Then guys, on the other hand, we also calculated ratios in the last class. Okay. So when I calculate the ratios, guys, it shows over here the answers are, it's this way, right? So we have a table. One is 2000x8. The other one is again 2000x8 according to the marking scheme. Right. This is guys 2000x8 restated. Right. This is 2000x8. This is the original. And over here, guys, we have 2000x7 also. Right. So, guys, GP margins, OP margins, and interest cover. Our answers are, guys, going to be number one, 2008 restated. They are telling 41%, it seems. Right. 2008 original answer is 46.1%. 2007 answer is, guys, 47.6%. Okay, then guys, on the other hand, operating profit answer, right? Operating profit answer, guys, we are getting over there, right? 9.9%. Okay, whereas guys over here it's going to be 20%, and then over here the answers are 24.2%. Then guys, interest cover ratio 1.7 times. 3.5 times, and guys over here the answer is going to be 3.8 times. These are the answers, right? Okay, right. Now guys, shall we quickly evaluate this question also, guys? This is a question that has been pending for 2 weeks. Shall we quickly finish it off? Right, so guys, now put the heading over the evaluation, please. Right, please put the heading over there, guys, evaluation. Right. Done. So guys, now they are asking like this over here. See, analyze the performance of Plundle Group for the year 31st of December 2008 and 2007. Your answer should specifically refer to the potential disposal of Holloway. So now guys, I have answers like this. See, with Holloway, these are the answers in 2007 and 2008. Without Holloway, these are the answers. So if I sell Holloway, you should tell every single time whether selling this is good or not, whether they are contributing more or not. Like that, they are telling, here see guys, your answer should specifically refer to the potential disposal. Now, if we dispose, these are the numbers. If we have them, these are the numbers. So you have to, mention about these every single time. Okay, now guys, can we then start reading this question, guys, over here? What's going to happen quickly? So I will take away the screen for the time being, right? Let's start this one. Okay, so you can now guys start reading. So guys, what happened here? Plundle Group owns 100% of Holloway. They received an offer to sell Holloway for 121 million. So if we sell, we'll get 121 million cash. This is the 100% owned subsidiary. Okay, guys, now can you look at these points faster? Please go through them quickly. Okay, yeah. The thing is, Basil, the other one I have taken it from here, from the question paper itself. Okay. We only calculated 2008 restated. So 2008 original answers and 2007 original answers question paper gave. That only I have copied it over there. Okay. That only I have marked it over there. Yeah. The other numbers what I wrote are from the question paper itself. That's why. Okay, right. So guys, others, then can you go through that part then? So guys, point number 2 says, guys, we have recorded an impairment because one of our customers left the business organization, right? So therefore, guys, we have marked an impairment because the customer left. So take that point into account. So normally, guys, when customers are leaving and if there is an impairment loss, right? Normally, guys, which ratio will that affect, guys, when we are evaluating? Right, impairment losses, guys. Now we calculate three ratios: gross profit, operating profit, and interest cover. Which one, guys, will it affect over there? Right, gross profit, operating profit, interest cover. Which one will that affect? Customer impairment. Okay, customer has lost, right? So it will affect whom, guys? Impairment will normally affect operating expenses, because normally, guys, impairment we charge it to administration expenses. So that's something that you can speak about when it comes to your operating profit margin. Okay, guys, now when it comes to okay, third part, we are a business who develop games, but Holloway is someone who is specializing in material packaging. Okay, right, but the games have now moved online. So the reason why we bought Holloway is to do our packaging, but now the problem is we don't need to do packaging anymore because the games are going online. Okay, so that maybe that's the reason why we are thinking of selling them. Okay, right. Next point. Plundle Corporation has experienced increasing competition in the recent years. This competition has led to, guys, increasing in competition. Which ratio will it affect? Competition is going up. Which ratio, guys, will it affect then? We have only three ratios: gross profit, operating profit, interest cover. Which ratio, guys, do you think it will affect us? That is one. But before that, what's the main ratio what it will affect, guys, if there is any increase in competition? Gross profit, because guys, increase in competition means what? Our sales is going down, our margins are going down, so that will result in our GP going down. Right, how about the next one, guys? Increasing in research and expenses, which one will it affect? Right, research, we looked at it earlier also. Now what are the two ratios? One is gross profit, because guys, if there is a research, we can charge it to cost of sale. Or else, what is the other one, guys? Operating expenses. Correct, that also it can affect. Good. Okay, guys, let's go for the next page. Right, look at this part. Okay, fifth point. Okay, look at the fifth point. For which ratio, guys, can we use this fifth point? Very good, interest cover. Okay, we can use this for the interest cover. Now interest cover, guys, you see, in 2007 and 2008 with Plundle, our answers are 3.8 and 3.5. Okay, without Plundle, what's the answer, guys? I got without Plundle it's 1.7 times. Okay, so that means not without Plundle, my bad. Without Holloway, it's 1.7 times. So with Holloway, we were good, 3.5 and 3, because you know why, guys? Those people are trying to pay their interest over 10 years. Let me, guys, go back to the question paper, right? These people are, guys, paying interest over 10 years. That's their policy. Now, can you see here? Holloway uses much longer leases, whereas our leases are very short. Because our lease is very short, we have to bear high interest. So in 2007 and 2008, our answer is 3, which is good. That is because of Holloway. Now that the Holloway is sold, now what's going to happen? Our interest is very high, so we are unable to keep up with these payments. So actually having Holloway is a good thing, it seems, but let's evaluate further and see. All okay right now, guys? I have now discussed the question. Now, guys, can you start writing the points now fast, one by one? Start with gross profit ratio, guys, quickly. Okay, put the heading performance and start with that, please. Guys, if you want, you can calculate individual ratios for Holloway if needed. If you have enough time in your exam, now see, guys, Holloway's revenue, Holloway's gross profit is given, so you can calculate his own gross profit. I mean, no need to calculate, but just see what is the answer, guys, we are getting for that one. 18,080 divided by 33,500, that is 53%, right? His gross profit ratio is 53% alone, right? So these are some points what you can use. Okay, right? Because now see, guys, 46.1% and 47.6% is the group. No, group means what? Holloway and Plundle both together, but Holloway alone is making 53% gross profit margin. That means, guys, who is the person who is bringing this company down? Is it Holloway or Plundle? Plundle is the one who is bringing the performance down. See, guys, look at this video. In 2008, both together 46.1%. Holloway alone, I calculated the gross profit ratio. You can calculate, right? It's 53%. So Holloway alone has a more margin than the group itself. So the one who is not performing well is Plundle and not Holloway. Because of Holloway only, it is at least 46.1%. Like that, you can start doing. So if you want to make your answer much better, you can calculate individual ratios for Holloway even, so that you can show he is important and not to sell him. Okay, right? Okay, continue, guys, with your work then. Right, continue with your work. Right. So, guys, I believe this is the third consolidated question we are doing. Okay. Uh, Individual ratios, I think we have done quite a few, around 3, I guess. And in the pre-mock, I did another one, so that's 4. Individual ones, not a big deal. Consolidated one only, we have to focus more on. Okay. So his one, guys, alone gross profit is 53%. How much is his operating profit? His operating profit alone 13,580 divided by 33,500. It's 40%, guys. This person's operating profit alone 40%. Okay. Try it now. We have done 336 now with the pre-mock 7 now. Try to do another three more. Okay. Try to reach 10 before the exam should be fine. Okay. And, guys, interest cover 13,580 divided by 1,900. He alone can pay 7.147 times. Okay. These are the individual ratios of Holloway for 2008. Huh? No, this is the third one. No, what we are doing. Okay, this is the third one. Because I remember there was a question that active division something. Okay, but anyway, after the break, we can touch another one also. Okay, if possible. Yeah. So this is second concept, no? But we need one corporation also, no, in your list. I think that's not there. Okay, right. So guys, I hope you're starting to evaluate the question. Let me also guys mark the points one by one quickly, whatever that you're writing. Okay, right. Okay, so guys, we can now start marking point number one. And okay, let's start guys over here. Now, first thing we can tell, right? Right. After the disposal, right? Okay, first of all, guys, we can tell like this, right? Okay. Over the year, the gross profit has fallen, right? The reasons could be, right? The reasons could be, right? Number one, fall in revenue could be, okay, right? Fall in revenue due to heavy competition, okay, due to heavy competition, right? Due to heavy competition, right? Right. Yeah. Another batch over, another cake. No, the second time I think I'm getting. I think you all gave one when you're doing MA also. No. Yeah. I take this one. We have tissue. Okay. It's okay. I think there's something I can keep it here. No problem. Right. Thank you. Okay. Right. So guys, fall in revenue due to heavy competition. That's one thing what we can say over there. Right. Second thing, right? We can also say, right, the business engaging, right, in research projects, in research projects. That is one thing, right? Okay. Right, but then guys, you have to also point wherever possible how important is Holloway. But then on the other hand, guys, you can tell, right? Right. With the disposal of Holloway, right, the gross profit is down even further at 41%, right? And with close inspection, right, Holloway alone, right, Holloway alone generates 53% of gross profit margin. Guys, like I said you, I individually calculated the ratio for Holloway, right? Holloway alone, how they are performing. So it's 53%, right? Which reflects that their packaging business, right? Their packaging business is doing quite well, right? Their packaging business is doing quite well. And it's Holloway who has been contributing, right? Contributing much to the group performance. Okay, much to the group performance, which is a reason, right? Which is a reason on why, which is a reason on why Holloway should not be disposed, right? Which is a reason why on Holloway should not be disposed. Okay, right? So guys, any doubts if you're having on my points, you can ask me, right? Then guys, next one, let me move on to the operating profit part, guys. Operating profit, right? Okay, right. Operating profit, right, has declined from 2000x7 to 2000x8, right? And it's now gone down by almost 50% with the removal of Holloway. Okay, so why do I say that, guys? Now you can notice this. Now look at this one, will you? Here it's 20%. Now from 24 it became 20. So we have facing heavy competitions. Maybe we don't have proper control on our expenses, right? So it has dropped. But if I remove Holloway, 20 becomes now 10. 10% we are losing because we are removing Holloway. And guys, see, Holloway alone is generating a gross operating profit margin of 40%. So he seems to be doing good alone. Okay, he has good control of expenses, and even guys, remember there is an impairment. One of his major customers went bankrupt. Even with that impairment, still he is getting 40% alone. So these are points that you can speak on. Okay, so let's start marking, guys, over there, right? Has declined 50% with the removal of Holloway, right? Which suggests that, right, the business has a poor control, right, on expenses, right? There is also an impairment during the current year, right? There is also an impairment during the current year. What are the other things, guys, that we can mention over here, right? Is there anything else that we can tell? Right. Right, but Holloway alone generates an operating profit of 40% even with a customer, even with a major customer being bankrupt. Right. So guys, since this is a major customer, we have to little bit take that into consideration because it's a major customer now. Next year, what's going to happen to Holloway's revenue is now a little questionable, right? Right. So Holloway also even with a major customer being bankrupt, right? But the bankruptcy, right, should be taken into account as to what will happen to Holloway's revenue in the next year. Okay, as to what it will happen in the next year. Right. But then we can also add Holloway seems to have a better control of expenses when compared to Plunder. Have a better control of expenses. Holloway seems to have a better control of expenses. Okay, right. Okay, now guys, why do I say that particular point that this person has a better control of expenses? Guys, now see, when I calculated this person individually 53%, but operating profit is 40%. That means they are losing only how much percent? 13%. No. But whereas guys over here, can you see us as a group, we have lost 26%. Okay. See guys, our GP is 46, but OP is 20. We are losing 26% as a whole. But Holloway alone has only lost 13%. So his control of expenses is much better than ours. So it is his contribution, who is keeping things like well for the group. So therefore, guys, you can write over here, right? This is right another point, right? Another point on not on not to sell Holloway, not to sell Holloway. Okay, then guys, last part, let's quickly now discuss about the interest coverage ratio, guys, faster. Okay, let's talk about that interest coverage, right? Okay. Right. The interest coverage ratio, right, with the removal, right, of Holloway is only 1.7 times. Okay, is only 1.7 times, which shows, right, that Plundle alone shows that, okay, right, Plundle alone is unable to make interest payments with the available profit. 1.7 is not good, okay, with the available profit, due to, right, their leasing policy, right, leasing policy, right. Holloway alone can pay interest, right, 7 times, right. Holloway alone can pay interest 7 times, as their lease is spread over 10 years, which gives a lower finance cost. Now, in this case, like, to be very honest, there is no benchmark, but taking the context into situation. Earlier we were 3, now we are 1. So we have fallen down twice. Holloway alone can pay 7 times. We alone can only pay 1. So relatively, when you take the context, we are at a very lower level. Okay, right, lower finance cost, right. Okay, this is another reason, right, to keep Holloway, right. Then guys, last part, we can now give the conclusion, right. Right, from the above, it could be noted that Holloway is a major contributor. It's a major contributor to Plundle Group's performance, right. With the decline in revenue for Plundle, in their industry, and sound performance of Holloway it would be ideal to hold Holloway rather than disposing. As the organization does not need, okay, as the organization is not in a need regarding cash flows. Okay, right. So guys, what is the meaning of that sentence what I have written there? Now guys, see, now see, in every aspect of the performance, Holloway is good. You understand? Right? Now, the only reason why forced to sell that company would be to get that money. Now, when you sell Holloway, you're going to get some money. No? So the question says we are going to get 112 million cash using that. So the only reason that it makes sense to sell Holloway is to get that 112 million cash. But in the entire question, guys, when I go through the question, does it say that Plundle needs cash? Like, is he having like an overdraft situation or something like that? No, no. So it doesn't seem like the business is in need of cash. So it doesn't make sense to sell Holloway, right? Because it's an organization who has been contributing well towards our performance. So the conclusion is not to sell unless you are in a need of cash. Right? Okay, copy and finish it off, guys, faster. Okay, so guys, now once we are done this part, guys, over there, you all can now guys take your half an hour break, right? And guys, can you come back at 4:30? Now the one question we will do on consolidated ratios. Okay, right. Have your break and guys come back then. He needs to get this weight. Okay, right. So guys, let's continue after the break. Let's do one more ratio question consolidation. We'll calculate. Let's discuss. Then you can write the points down later even. Okay, let's do a discussion quickly. Right. Right. Last question, guys, on consolidation. Okay. Guys, can you all go to this question, guys, over here, the one before room? Okay. Right. Question name 446 Marvel Corporation. Go to that part, guys, over there. Right. Okay, please go to guys the above question that says Marvel Corporation. Right, go to that one. Okay, right. Shall we start, guys, quickly then? Okay, look at the question then. Right. On 31st of December, Marvel owned a number of subsidiaries, including a 100% equity share in someone called Bilston. Extract from the draft summarized financial statements for Marvel Group is given below. Okay, so they have given, guys, remember 2007 and 2006, both of these are, guys, what? Consolidated profit and losses. Okay, both of these are, guys, what? Consolidated P&L. Okay, then what they are telling? Okay, then there is a consolidated SOFP also. Right. On 30th of June 2007, guys, now take this point into consideration. Our question is going for December 2007 and 6. On 30th of June, Marvel sold all the shares in Bilston for 22 million. Okay, so when you sell a subsidiary, we call it as what, guys? Group disposal. But when is it happening? It's happening in June. This year, after how many months? Very good. After 6 months, we are selling the subsidiary. So take that into consideration. Okay. So guys, in this paper, what they are telling, A part, calculate the profit or loss on disposal in Bilston Corporation. So it's a group disposal. They are asking you to calculate gain or loss on disposal. Shall we start the calculations, guys, quickly, and then we'll discuss the points fast. All good. Then you don't need to write everything. You just listen to, I mean, you give your points and I will give my points like that. Let's have a quick discussion faster. Oh no, we just started off. Okay, the previous question called Bilston 446 we are doing. Okay. Okay, right now, guys, can you start now marking this with me now, guys, quickly? Okay, so put the heading. What are they asking you guys to do? They are asking you to do group disposal. Can you guys write the equation faster? Right. Requirement A, group disposal. Right, so guys, for group disposal, how do we calculate? What's the equation? First, we need sales proceeds minus net assets at disposal, goodwill at disposal. Okay, goodwill at disposal, and minus NCI at disposal. Right, this is guys, remember, this is the 100% owned business, huh? This is a 100% owned business. Okay, guys, now can you look at this paragraph and get me the answer, guys, faster, for group disposal? Right, please try to calculate for me the group disposal answer. Okay, let's start on that one, please. So guys, only by looking at the paragraph can you get me, guys, the answer for group disposal. I'll give you around, guys, 5 minutes to 10 minutes. Okay, let's start on that one, guys, and quickly. Which one? No, no, that no need to do. That we don't have to do it that way. You can just take it as it is. One minute, Amjad. No, smaller. A little bit. Can you just check and see one more time? The profit, no? Yeah, that's the correct answer, Shahla. That should be the correct answer. Good. Yeah, that's correct, Sazri. Now, Amjad, now your answer is correct. Good. Yeah, good. Shahlaw's answer is correct. Okay, guys. Now others who are doing the question can little bit check and say it because now some people have finished. I'll discuss. Sales proceeds. Guys, we are selling this company for 22 million. So let me mark that here. 22 million. NA, guys, what is NA? Net assets at the disposal date. Guys, we are selling on June. No, that time the net assets are this much. 20, 23.2, 23.2 minus 5. How much, guys? 23.2. Okay, so therefore guys, it's going to become how much? 18.2 million, right? That is the net assets at the disposal date, 18.2 million. Then guys, goodwill at disposal. Guys, listen, in this question, first of all, the goodwill is not provided. Okay, so you have to calculate, right? So first of all, what you should do, guys, you have to calculate here goodwill at acquisition. Now, normally, how do we calculate goodwill? First, we need investment. What is investment here? 25 million. We are paying 25 million to buy the company. All good? Right. Then, after investment, guys, we should add fair value of NCI. Do we have an NCI in this question? Answer is no, because we bought 100% of this company. So, therefore, guys, there is no NCI. Minus net assets at what date? Acquisition date. Here, guys, can you see net assets at the acquisition date? 2300. Sorry, 23 million, right? So, therefore, guys, now based on this, okay, now based on this one, 2 million will become the goodwill, but that's the goodwill at the acquisition date. We can't take goodwill at the acquisition date. No, I want dispose goodwill at what date? Disposal date. Then what should we do? From goodwill at acquisition, you have to subtract impairment. Then you will understand what's the goodwill at the disposal date. The paper says goodwill has been impaired by 25%. Okay, so guys, now when I check for impairment of 25%, what will be the answer in that case? 0.5 million. Therefore, the goodwill at the disposal date is 1.5 million. Mark it, guys, over here. Right now, guys, at these two, then you will be getting 19,700 There is no NCI in this question because it's a 100% owned subsidiary. So therefore, guys, based on this one, we are getting a 2.3 million profit on disposal. And the paper says this gain has been included in administration expenses, right? They have set off the gain to administration expenses. Right, can you guys copy this down faster? Let me know for any doubts that you have on the calculation. Okay, so guys, are we now all okay with the goodwill at disposal? Okay, no? Yeah, okay, now so guys, we got a profit, huh? Right. And also remember, we got some cash also. That's important for the calculation. We got some money and we got a profit also. Okay. Right now, guys, what they are telling here, the group has recently encountered difficulties in trading, which led to the decision of disposal of Bilston. The results of Bilston were included in Marvel Group's consolidated profit and loss for 6 months. Right? Now, in that paragraph, what they are trying to tell you is this. Guys, now see, in 2006 consolidated P&L, Marvel plus Bilston, 100% performance is inside this. But in 2007, Marvel's 100% performance is there. Bilston's only 6-month performance is there. Because after 6 months, we sold the subsidiary, guys. So only 6 months income and expenses of Bilston is inside this profit and loss account. That's one thing that you should learn. Second thing, guys, what you should know is in the statement of financial position in 2006, it's both Marvel plus Bilston. But in 2007, it's only Marvel's numbers that you see there. Because you're preparing SOFP on the last day. No? On the last day was Bilston with you. No. So these numbers in 2007 SOFP are only whose numbers? Marvel's numbers. No Bilston numbers are inside this. Okay. Then guys, on the other hand, now what they're asking you to do, calculate the ratios for the group 2007 and 2006. Now guys, shall we quickly start calculating? After that, points no need to write. We'll only discuss and we'll finish off the class with that. Okay, right. So guys, they're asking now gross profit, operating profit, return on capital employed, and also guys net asset turnover for you to start calculating. Right. Now guys, let's start calculating it together then. Okay, so I'll give you the data. Right. So they're asking guys from you 4 ratios. Okay, can you guys quickly set up the 4 ratios faster? Okay, set up the 4 ratios quickly. So guys, they're asking for 2007 and 2006 both. Okay, so let me then draw the table. So they are also asking us net asset turnover. Net asset turnover means guys normally revenue divided by capital employed. These 2007. Okay. And then guys, these 2006. Okay. Right. Now, guys, first of all, from here, whatever the numbers that you want, can you guys copy it? Now, guys, I can't. Now, SOFP is in one page, income statement is in one page. So, therefore, guys, first from here, can you copy, guys, whatever the numbers that you need? First, copy from there. Okay. Whatever the numbers that you need, first copy it from here to there, guys, faster. I'll give you a few minutes time. Okay, so guys, from this page, have you copied down whatever that you need? Shall I guys mark now? Okay, 2007 gross profit 60,000, 2008 gross profit 80,000. Right, next one, guys, down revenue, right? So the revenue, guys, 275,000 for this one. Okay, right, into 100. Whereas, guys, over here it's going to be 80,000 divided by 375,000 into 100. Okay. Right. Then, guys, on the other hand, operating profit, guys, just copy the numbers what they have given directly, 23,500 over here, divided by revenue, 275,000 into 100. Over here, guys, we have profit from operations, 43,000, right? That divided by 375,000 into 100. Again, guys, operating profit, 23,500. Here, guys, 43,000 divided by capital employed. Here the revenue I can write 60,000 and the revenue, guys, 80,000. Now the only thing, guys, what I need is now capital employed. So capital employed, guys, we normally find from the next page. Okay. So, guys, quick recap. What is capital employed? Capital employed is, guys, the equity plus what? The non-current liabilities. This is what we call, guys, capital employed. Okay. Capital employed means what, guys? The equity, right? So in our case, the equity is 226,238 and the non-current liabilities. Okay, now guys, start marking that one over there. So 226,000 plus 15,000, 241,000, I believe the answer. Here, guys, 238,000 plus 140,000 will give me 378,000. Okay, 378,000 into 100. It's included inside equity, correct? not current liability. Okay. Over here also, guys, 241,000 into 100. Here, guys, we have 378,000 into 100. Right now, guys, can you quickly copy and calculate these ratios, guys, faster? Disposal profit 2,300. Okay, disposal profit is 2,300. For that working, I did it over here. Okay. Right. Guys, can little bit check and see, guys, ratio answers, but these are okay, guys. Faster, let me quickly mark them. So first one, guys, gross profit, it shows 8.5%. Okay. Whereas, guys, over here we have the other one, 21.3%. Right. Then, guys, this one over here, the operating profit. Sorry, guys, gross profit is, I think, 21.8%. No? 21.8 and 21.3. 1 minute. Revenue, no? Yeah, the revenue is not the revenue, no? This is the gross profit. Thank you, Shima. It has to be 275,000, and over here, guys, revenue has to be 375,000. Okay. Right. Then, guys, over here, according to a student, 8.5%. Okay. And, guys, the other one, 11.5%. Okay. Right. Then, guys, over here, 9.8%. And, guys, over here, it's 11.4%. Okay. Right. Then, guys, last one, net asset turnover. Over here, guys, there's a small change, 1.14 times. Whereas, guys, over here, right, 0.99%. So 0.99 times. Okay. Right, guys, these are the answers for the ratios. Okay, these are the answers for the ratios. Okay, right. Right now, guys, we don't need to write the points. We'll just have a discussion, and then you can later look at the marking scheme and also take the points. No, okay. So let's just have a discussion quickly on what are things that we can write and how you're going to evaluate these questions. Okay, can you guys quickly copy down the answers for ratios, guys, faster? Copy down the answers, please. Okay, all good, guys. Shall we start then? Right, we'll start evaluating quickly. Right, guys, now see, first of all, can you guys quickly give me a comment about the profit and loss? All the numbers have reduced. What is the main reason, guys, behind this one? Okay, right, 2006 to 2007, guys, all the numbers, see, revenue, cost of sale, gross profit, everything has reduced over the year. What is the main reason, guys, behind this? Why has it dropped? Exactly, because of the disposal of the subsidiary. Guys, in 2006, the answers are what and what? Marvel and Beano, both together. But in 2007, guys, these numbers are only what 6-month performance of bill. So therefore, because 6-month performance of B is there and 6 month is not there, obviously all the answers when compared to last year are going to be less, right? Simply because now even guys in SOFPO, same story. Now guys, can you see here? Property is less, non-controlling interest is less, loans are less. Overall, the numbers have declined from 2006 simply because we have disposed a subsidiary. That's why it is less. Right. Now, guys, shall we comment about the gross profit ratio? Now, guys, look at this. Even though the revenue has fallen, now you can see, now, guys, right? 375 revenue became 275. 80 gross profit became 60. But our gross profit has slightly improved. Right? Even with the figures being down, gross profit has slightly improved. Okay, guys, now I'll tell you a small thing. Can you read this last paragraph over here and tell me what's the reason behind it? Okay. Read this last paragraph and guys tell me what's the reason behind this one. Why has our gross profit ratio improved, guys, when compared to last year? Right, what should be the reason? Right, our numbers have significantly gone down, but still our ratio has slightly improved. What is the main reason? What do you think, guys? Online people, what could be the main reason, guys, why we have why it has improved? Right, now guys, in that paragraph what they are telling, right, the group has recently encountered difficulties in trading which led to the decision of disposing Bilston. Now guys, can you see, without Bilston our gross profit ratio has actually improved. It means that, right, what is our company name? Marvel. We are actually doing good. Right, now this was not the case in the previous question. We were doing bad, subsidiary was doing good. But here, guys, over here what's going to happen? It shows that the company is having trading difficulties and we sold. So it seems like Bilston was not contributing much towards the gross profit. See, even without him, we are doing better. So even without him, guys, our company called Marvel, and also we have some more subsidiaries, we are performing well. So that's the reason, guys, why our gross profit ratio has gone up. You can tell that way. Right. Now, guys, can you talk about the operating profit part, guys, over here? Now, can you tell me, guys, now our operating profit, guys, has actually declined. Okay, 1 minute. Exactly, most of our gross profit has been made by other people. Yeah, it does include 6-month performance, but without the rest of 6 months, we have been doing better. What you said is true. Okay, right. Guys, next part, guys. Our operating profit, guys, from 11.5% is now only 8.5%. It has gone down. So one reason why the operating profit is going down is because one thing, our revenue has fallen. Can you guys tell me any other specifics on why it has fallen? You know, there's another one reason from here. Why our operating profit has, guys, fallen. Two reasons actually, right? From what you read in this paragraph. Can you guys check and let me know faster? Two reasons why our operating profit is. Now, guys, I'll just take this off for the time being. Okay. Now focus on this question and tell me two reasons why our operating profit margin is lower. One, revenue has fallen. Two other reasons, can you tell me by looking at this part? Exactly, there was an impairment of 25%, no? Right, so because there is an impairment that could have affected our operating profit. Guys, not only that one, you should also note that our operating profit has a one-off item. Can you guys tell me what is that one-off item that we have inside the operating profit during this year? Very good, that's the answer. How about the others, guys? There's a one-off item that's inside our operating expenses. What is that? Exactly, the profit on disposal. Here, guys, we made a profit on disposal of how much? 2.3 million. No, that's inside administration expenses. So that has to be taken into consideration, right? Operating expenses, operating profit has fallen even with that profit. Now, next year, we are not going to have this profit. So meaning the operating profit can be a little lower. Very good. So that's one. Right. Then, guys, there's another one thing I want you to focus and tell me over here. This part. Guys, look at this one a little bit. Guys, see, Marvel Group, do they have only one subsidiary? No, they have many subsidiaries. How do I know that? Here, guys, are telling over here. See, Marvel is a business organization who has number of subsidiaries. Guys, now look at this. When I started the question, my goodwill is how much? 8 million. But I'm finishing the question, my goodwill is 0. That means, guys, what happened to that goodwill completely? The goodwill has been completely impaired. Okay, see, starting goodwill is 8 million, no, guys, but now finishing goodwill is 0. Goodwill has been completely impaired. Okay, so 8 million impairment, but guys, you should understand from this 8 million impairment, 500,000 is related to Bilston. You calculated now 500,000. The remaining impairment is relating to other subsidiaries. So because of this big impairment, our operating profit has taken a big hit. Okay, it has gone down by 3% when compared to last year. So that's what we can talk about, guys, operating expenses, right? Then, guys, let's move on to the next ratio. Guys, ROCE 11.4 became 9.8. Can you guys tell me directly one reason why the ROCE fell? Because first, what happened? Exactly, the operating profit fell. Because the operating profit has fallen, our ROCE also has fallen. But then, guys, on the other hand, can you look at this part, guys, over here? Right. Capital employed. 378,000 worth of capital employed now only has become how much? 241,000. Capital employed has dropped. Guys, technically, when capital employed is reducing, what should happen to ROCE? It should increase. No, it should increase. But still, our ROCE has fallen down. Why? Because our operating profits are not good enough. Right? Our operating profits are low. Because of that, our ratio has not improved. Guys, can you tell me some reasons on why ROCE, guys, fell down in the first place? Can you give me some reasons? Right? Our return on capital employed is less. Our capital employed is less. Can you guys look at this SOFP and tell me why is our capital employed has reduced over the year, guys, faster? Can you check and let me know? What is the main reason why capital employed reduced? Because of disposal, no? Guys, when you dispose, right, subsidiaries equity, the Bilston's equity is not there, no? So that is why ROCE has fallen. Not only Bilston equity, can you guys look at this? Bilston's loans, right? With Bilston, the loan is how much? 140,000. Without Bilston, what's the loan? 15,000. So there's a big drop in loans, right? This big drop in loans can be described in two ways. One, we sold Bilston and got some money, no? From that money, we could have settled the loans. Or maybe all these loans are Bilston's loans. Once we remove Bilston, that loan no need to show, no? So because of that drop, our capital employed has reduced tremendously because we sold Bilston. But still, we are unable to improve our ROCE because our operating profits are quite low, right? So that reason, but we can tell. Right, then, guys, let's move on to the next ratio, guys, what we have. Right, net asset turnover. 0.99 net asset turnover became 1.14. That means, guys, it has gone up. Is it a good thing or a bad thing? Net asset turnover, guys, going up. Is it good or bad? It's good. That means we are efficient. But can you look at these numbers and tell me now? Usually, guys, when the net asset turnover increases, it means that we are efficient. But can you look at these two numbers and tell me, are we actually efficient? 1 minute, guys. Okay. Can you look at these two and tell me the two numbers? Look at the top denominator and the numerator and tell me, are we actually efficient? What do you think, guys? See, our revenue has fallen. Technically, when the revenue falls, net asset turnover should improve. Sorry, it should go down, no? But it has improved. What's the reason? Why has our net asset turnover actually improved? Because the capital employed has gone down because we sold the subsidiary. So it's not actually an improvement. Okay. Not actually we are efficient because capital employed has gone down because we sold the subsidiary, we settled the loans and all of those. So it's not actually we are not efficient. It's just that because we sold the subsidiary, it has improved our ratios. So we can tell that. Right. Anything else, guys, that we can speak on this question? Let's check and see. This one, everything taken care of. And guys, then you can, add points like now finance cost has fallen down. Okay, now see, guys, distribution administration cost has increased because of impairment, but distribution cost has gone down. So maybe our cost control is good. Finance cost has gone down. Guys, why finance cost fell down? Because we settled the. Normally, why does interest fall down, guys? Because we have gone and settled what? The loans. The loan has dropped now, guys. Here, can you see? 140,000 loan became 15,000. Tremendous change. Because of that, we are now saving up on our finance cost. Right, then guys, when I go to the next part, PPE has reduced because we sold the subsidiary. Goodwill has gone down. Impairment, we already discussed about it. Retained earnings have gone down. Guys, look at this. We are making a profit, but still retained earnings has gone down. What's the reason behind it? Right, we made a profit, but still retained earning has gone down. Guys, normally why does retained earning goes down? Because we have paid what? Dividends. The organization has paid a good amount of, guys, now see, 18 million retained earning, 9 million profit means it's 27 million. No, can you see our retained earning starting is 18 million and then 9 million means it has to be 27 million, but it's only 12 million. That means a big amount of dividends we have paid. That has to be questioned, right? We have paid a huge amount of dividends during the year. Right, then guys, our loans have reduced. That's because we have settled the loans using the money that we have got. So overall conclusion, guys, we can tell it like this, right? As the organization is having trading difficulties and maybe because Bilston is not performing as well as we have expected, right, we have sold off that subsidiary. Most of the ratios have improved. Some simply because the ratios, right, I mean, now you saw, no guys, net asset turnover and all, not that we are doing well, but it's just that mathematically it has improved. So we can come to a conclusion, okay, selling Bilston was a good thing because financial performance, it has improved. Guys, one more thing you should tell, one thing. Now see, now when you can add it as an additional point. Guys, can you tell me, in profit and loss account 2007, we are having whose and whose information? Marvel and Bilston, how many months? 6 months. But when you take 2007 SOFP, we are only having whose information? Only Marvel. So sometimes when calculating ratios, it does not give the exact picture because this is Bilston plus Marvel, no? But assets are only whose? Marvel. So when you calculate ratios from that and this, when you calculate, like for an example, ROCE, net asset turnover, see guys, now see, now when you take ROCE, what I'm trying to explain is this. In ROCE, operating profit and this revenue you are taking from an income statement, no? That is Marvel's full year performance, Bilston 6 months performance. But capital employed is only Marvel's capital employed. So when you're calculating the ratios, it doesn't show the exact figure, distorted figures we say. So that is something that you can mention when you do your evaluation. So this is how guys you need to evaluate this question. Just check the marking scheme also and then you can mark your answer. But I have discussed on how you are going to do. Okay, right. So guys, then with that, then I will be then concluding guys today's class, and most probably guys, if I'm not wrong, this should be the, because you know why, the capital employed is only showing the year end answer now. Okay, revenue is Marvel's full year performance and Bilston's 6 month performance, but capital employed is only Marvel's because that's at the end of the year. So you're dividing one, like 1.5 year performance with 1 year performance, like that. Okay, right. So guys, and with that, then we will be then wrapping up FR sessions, right? This is the final class guys that we have before the exam. So I wish you guys all the best for the exams. The pre-mock recording should be available today, tomorrow. I'll just have a chat with the office before I go. Please go through that part guys over there. Make sure you complete the full paper. There's another ratio question there I am discussing, but that's single entity. Okay, right. All right guys, so that's it then. Okay.